Welcome to Market Trends. My name is Nichole Benson and I'm the Managing Director of Sales for the East Atlantic region. Today, I'm joined by Trevor Ramsey and Dave Erickson from our strategic consulting team. Both of them have over 40 years of combined experience. And I'm looking forward to tackling a couple topics that continue to pop up in my conversations with clients: the global supply chain and the impact, and then sustainability. So let's go ahead and jump right in with global supply chain. Trevor, what is the outlook for OEM production delays?
Thanks, Nichole. And first, I wanted to say it's great to be here with both you and Dave. In terms of OEM production, the volumes are gradually improving, and the microchip shortage is moving towards a resolution largely as we anticipated. That being said, non-microchip supply chain issues stemming from lockdowns in China are now starting to have an effect on OEM production, as well as the auxiliary equipment that outfitters require to complete their builds. For the 2023 model year, most OEMs are making incremental changes to reduce any potential delays, and that includes prioritizing long-standing client relationships, allocating orders based on a client's past 3 years of ordering history, and from a production side, streamlining option content to be less reliant on those parts and components that are most at risk due to supply chain disruption. The bottom line is that we'll continue to see improvements over the coming months. However, predicting a complete return to normal is beyond the scope of the remainder of 2022 and the first half of 2023.
Great. Thank you, Trevor. Dave, what strategies do you recommend to our clients for navigating these production delays?
Yeah, thanks, Nichole. That's a question that a lot of companies are dealing with today. The most important thing we're recommending is to really nail down your replacement plan early. For example, before the supply chain crisis, it was normal to have 2 replacement cycles per year based on a 12-month forecast. And in the current situation, with very short ordering windows, the best practice is to have 1 replacement cycle per year based on an 18 to 24-month forecast. The key is to have everything ready to go so that you can place orders as soon as the order banks open. Another thing to keep in mind about the OEM production delays is that it's created a very strong resale market for used vehicles. So if you do have any spare or underutilized vehicles in your fleet, this is a great time to sell those at a premium.
And Dave, with our clients holding on to vehicles longer, I'm sure this is impacting maintenance as well. So how is the supply chain impacting repair spend?
Yeah, of course. It's important to remember that the same supply chain challenges that are affecting new vehicles are also affecting the spare parts needed to repair existing vehicles. So what we have now is the situation where companies are forced to keep their vehicles for longer than they used to, while at the same time repair prices are higher due to that shortage in both parts and labor, all of which is pushing repair spend higher. In this situation, we're recommending that companies keep up with preventive maintenance in order to avoid problems. And then when a repair does become necessary, to schedule that appointment early so that a minor repair doesn't turn into a major one.
And with maintenance spend on the rise, how should our clients budget for maintenance in 2023?
When we're talking about budgeting, the first thing to consider is what to use as a baseline. If your company was one of the many companies whose operations were impacted by the COVID lockdowns, then 2021 and 2020 were probably not normal years for you. And so you probably have to go back as far as 2019 in order to find a really good baseline for those budget discussions. Then you want to keep in mind that in a normal environment, maintenance spend is a function of vehicle age and mileage, so that as we keep these vehicles for longer, we need to plan on maintenance costs going up as well. A traditional rule of thumb is that a 10% increase in vehicle age will result in a 10% increase in maintenance spend. However, in today's environment of high inflation, along with that parts and labor shortage, a 10% increase in vehicle age is more likely to result in a 15 to 20% increase in maintenance spend.
Let's shift now from supply chain challenges to a little bit more exciting topic: sustainability. Sustainability certainly comes up in every single client meeting that I have, and I know we have a lot of clients that are excited to begin pilots. Trevor, vehicle choices for electric vehicles are still somewhat limited. When is EV availability expected to improve?
Yeah, that's a great question. EV product offerings are continuing to evolve. but thus far they've centered around compact sedans and the crossover space, or else the high-end luxury segments. The good news is that all of the major OEMs continue to make their own sustainability commitments, and it's expected that the number of EV product offerings will double by 2024. And what that's going to translate into is somewhere in the range of 120 to 130 unique EV models available.
So Dave, I've been walking through a lot of life cycle cost analysis with our clients that include both EV and ICE vehicles, and often get the question, when will EV vehicles reach the cost parity with ICE vehicles, especially now with fuel prices being so high?
Yeah, we're in a really interesting situation right now where that high cost of gas has caused some electric vehicles to achieve cost parity with ICE vehicles already. Back when gas was $2.50 a gallon, the expectation was that it would take a few years before most EVs would achieve cost parity with ICE vehicles. We expected that would happen through manufacturing economies of scale, and more specifically to a reduction in the cost to manufacture batteries, which are an expensive component of EVs. So the bottom line is that today's gas prices have tilted the scale, making this a great time to at least begin to pilot EVs in your fleet. And that way you can be ready for full-scale implementation within the next couple of years, assuming that those economics work out as expected.
Well, thanks Dave and Trevor for joining me today and sharing your insights as our clients look ahead to 2023. And also thanks to everyone for watching.